let's say that somebody wanted to buy apartment complexes and they didn't have any money. Can they actually do it? And how?
Can you do it with like zero money? Well, you can, but you've got to at least educate yourself, okay? Because you first have to build your competence. You need to be competent in the subject matter, whatever you're going to do, any business, certainly multifamily as well. But that competence then equates to confidence, which will then equate to your ability to influence people to invest with you.
What would you say would be the things that somebody has to get competent on before getting into the apartment complex game?
Building your team, that's number one. Creating your investment criteria. You can't be all things to all people. What size properties you're going to go after, what asset class, in what market, in what submarket. How do you evaluate that submarket? What do you look for? What needs to be happening there? What websites do you use? How do you get deals coming across your desk in a big way? How do you find deals? All the different ways to do that, and there's tons of them. What happens when you get a deal? How do you do a preliminary evaluation to see if it makes sense, if it's worth digging into deeper? Then, how do you dig deeper? How do you do the underwriting? Then the due diligence.
Hi, everybody. Jose Luis Morales. Welcome back to the Residual Real Estate Agent Show. This is episode number 121. Today, we've got a very special guest. His name is Rod Khleif. He is an apartment investor. He also teaches people how to buy apartment complexes. Today, he is going to teach us how to buy apartment complexes with no money down. Welcome to the show, Rod. How are you?
Oh, good, Jose. Thanks for having me, buddy. Let's have some fun today.
Thank you for being on. So I wanted to have this topic because I run into a lot of people who are like, well, I want to buy a property, but I don't have money. Or I want to buy a property, but I don't know where to get started. And a lot of people almost use the money thing almost like a mental barrier. But to my understanding, and obviously you can buy properties with no money down. So I kind of wanted to make that available to somebody. So let's say that somebody wanted to buy apartment complexes and they didn't have any money. Can they actually do it? And how?
No, they actually can. And I know it sounds like hyperbole, like it's, gurus talk, no money down kind of a thing. But, the bottom line is you absolutely can. And here's why. Now, these properties take money to buy, obviously. You're going to get financing, and there's what's called a capital stack, which includes the financing and then the equity you bring to the deal, which is, in the commercial real estate world, equity means the down payment, the closing costs, the money you raise for the capital expenditures, the fix-up you're going to do, the operating reserves. That's all equity. But those deals obviously require that, but it doesn't have to be yours, okay? There is so much money looking for a home right now. It's like staggering because, look what's happening in the stock market. It's May 11th today, and it's crashed like crazy. And, there's big talks of a recession and so on and so forth. And so people are looking for a place to still get decent returns. So here's the thing now. Now, can you do it with like zero money? Well, you can, but you've got to at least educate yourself, okay? Because, here's the way I equate it. You first have to build your competence. You need to be competent in the subject matter, whatever you're going to do, any business, certainly multifamily as well. But that competence then equates to confidence, which will then equate to your ability to influence people to invest with you. I'm going to tell you, when I was in my 20s, I bought millions of dollars worth of property, 50-50 with partners. They put up the money. I found the deals. I fixed them up. I managed them. I rented them. I sold them. Everybody was happy. You can do the same thing. Those were joint ventures. So a joint venture is a great way to do a deal, no money down. If you find somebody that's got liquidity, that's got some cash, they want to invest it, you split a deal with them. You say, listen, I do all the work. I'll do all the heavy lifting. Maybe a white collar professional like a doctor, dentist, whatever, business person, and I'll do all the work. You put up the money. We'll split the profit. Whatever, that doesn't have to be 50-50. It can be, more to their favor, whatever it takes to get it done. But you can absolutely do deals that way. But again, the caveat is you've got to educate yourself before you do this, because otherwise they'll be able to see through it. You've got to build that competence first. So the first one I would say is joint ventures. That's a fantastic way to do a deal. And I did tons of them that way. And I have students that, have done tons of them that way. So joint ventures is a good one. Another one is seller financing. If you're going to go direct to seller with your marketing, like mailers, outbound phone calls, things like that, you can sometimes do deals nothing down with sellers. I've done it. Not typically, and I'll give you some tips on this. And I teach all this at my boot camp, by the way, and I've got a 3-day one coming up in Denver. I'll tell your peeps how to come if they want to come. It's a hell of a deal. But if you're going to do mail, for example, I like to go after people that have owned at least 20 years. Okay. And here's why, especially as it relates to no money down, because if they've owned 20 years, first of all, they're retirees. Okay. Secondly, Secondly, their tax benefits have run out. So they're fully depreciated on their 20-year straight line depreciation. They don't have any more tax benefits. So if they sell, they're going to end up with 60, 70 cents on the dollar after Uncle Sam takes their money. And then they're also risk averse. So they're not going to want to take that money from that big investment in their life and put it into another high risk investment. They're going to want to put it in the bank. And what's the bank paying in interest, right? Like nothing. What you want to do is you want to be really good at having a conversation, something like this. Mr. and Mrs. Smith, I'm going to buy your property for $1 million, but because you're fully depreciated, you'll end up with maybe 700,000. And if you put that money in the bank, this is how much money you'll make from it. And you figure out what the payment will be. Here's what your payment will be. Now, if you work with me, I'm going to give you enough of a down payment. So, I'm serious, although I'll tell you how you back into not having to do that. But let's start with that. So I'll give you enough of a down payment. So, I'm serious, but I'll pay you a 3, 4, 5, 6% interest. And you're only going to pay taxes on the amount of money you get from me every year. So it's going to be a fraction of what you'd have to pay if you sold the whole thing. So your payment for me is 3 or 4 times what you'd get from the bank. And it is. And you want to figure that out for them. Now, how you do it nothing down is through seller bonding. Okay. And I've done deals because retirees, they're more relationship driven than financially driven, and you want to connect with them, not to take advantage of them. But I'm going to tell you, if you don't have this conversation with a retired seller, you're doing them a disservice, because seller financing is usually the best solution for them because they want that cash flow. But if you bond with them and focus on the relationship first, I've done deals nothing down. They just wanted the payments, no problem. I've done deals where I haven't made a payment for a year because all the money from the property had to go back into the property because it was so trashed, and it was the truth and I bonded with them and I was able to do it. So seller financing is another way, no money down. Another one is syndication. Okay. If you syndicate a deal where you're raising money and you do, an SEC exempt syndication, there's the 506B program, which is what I started on 40 years ago. And then there's the 506C, which came about from the Dodd-Frank Act. The first one, 506B, you can only deal with people you knew and you couldn't advertise. You still can't. You cannot advertise on that. You can't even post on social media. The 506C, you're dealing with accredited investors, so you can advertise. I host a podcast. I'm blessed to say it's the largest commercial real estate podcast really in the world. We're about to hit 13 million downloads, and I can talk about it on that show all I want when I have deals. And of course, when I talk about it, my dance card fills up pretty quick. So that's the 506C. There's also a bigger way you can go. It's called a Reg A plus deal, which is a fund, and then you can go to both, but you have to be audited by the SEC, and it's a longer process. It's more expensive. The most common is the 506B, where people deal with people that they know and bring them a deal, and they do a syndication. And I know that sounds scary, but again, if you can come to my boot camp, I'll mention that real quick. It's July 29th, 30th, and 31st in Denver. I'm going to have a syndication attorney there teaching you syndication. It's 3 days of training. It's not a sales pitch. It's just drinking through a freaking fire hose about this business. And you can come for $197. So it's kind of a duh if you're interested. And so if you're interested, text my name Rod to 72345 or go to multifamilybootcamp.com. Now, because you're a friend of Jose's here, I've got an awesome bonus package where if you just remember to use the word bonus when you check out, you'll get my deal evaluator software so you can evaluate apartment deals, and you'll get my document library, which I've spent tens of thousands of dollars on. So those two things alone are worth 10 times the $197. Now, if you're watching this and the price has gone up, DM me on any social channel and I'll make, because it'll go to $700 at some point, and I'll get you the $197 price. So again, if you can make it, it's an incredible opportunity to learn the business. And again, it's not a sales pitch, so it's kind of a no-brainer. But syndication is another great way to do deals without your own money going into a deal. You're raising money from investors, passive investors. So what's the difference between a joint venture and a syndication? In a joint venture, the first thing I talked about, everybody has to be active. Like when I did this in my 20s, my partners maybe signed on debt, or if I spent more than like $1,000 to fix a place up, I had to get their permission. That's active. If you take money from someone and you just give them a rate of return, you better syndicate. Now, it just means writing a check to an SEC attorney. It's not like the end of the world. You just got to dot your I's and cross your T's, but don't do that. Okay. In fact, I just caught a guy. I was on Clubhouse and this guy had really nice things to say. He knew who I was. And I messaged him because he was doing a deal on a house in another country, and he was bringing 10 people together to buy this thing. And so I messaged him. I said, hey, I want to talk to you afterwards, because I knew he wasn't just syndicating and he needed to, because he was taking their money. And again, you do not want the SEC knocking on your door. So there's a few ways right there that you can buy a property nothing down. Those are probably the most common ways. And certainly you can do some creative financing. There's things like that as well. But those are the three most common ways, Jose, to buy a property nothing down, to buy a multifamily property nothing down. And I've bought literally thousands of units that way without money out of my own pocket. Okay. Now, sometimes what I would do is I would bring partners in on the general partnership side of a deal. In a syndication, you've got the general partners and you've got the limited partners. And I would bring people into my side of the deal, the general partnership, that would put significant cash in, but it wasn't mine. With apartment deals, you'll also have what's called the at-risk capital, which is like the earnest money. It's like the third-party reports you pay for to get the financing. It's the due diligence costs, scoping the sewer line, stuff like that. And you can have somebody put up that money as well. We do that, and they get a piece of the deal, and they putting up the at-risk capital. Now, of course, again, this ties into you're having competence and confidence in the ability to influence, because if you're going to influence somebody to put up the money that's at risk, they better feel pretty good about you. So again, if you're interested in this, for God's sakes, come spend 3 days with me in Denver. It's United's hub and nonstops from everywhere in the country. It's a no-brainer. But if not, come listen to my podcast. Keep listening to Jose here, and you'll get acclimated. You'll get up to speed. But there you go.
What I was going to ask you, Rod, is I think the main thing that you said, if you want to buy real estate with no money down, you've got to be competent.
Yeah, you need to learn it. You can't dabble. If you dabble, you're going to get your butt kicked. You need to learn it. It's like anything else. Everybody starts out an amateur, and so you just got to apply yourself and you learn it. You'll learn a lot from my podcast. It's called Lifetime Cash Flow Through Real Estate Investing. Check that out. I also have the largest multifamily Facebook group in the world. Just look that up. About 45,000 people in there. So and you want to be around people that are doing this. Okay, I have a coaching program. I'm not going to sell you on it, but my students now have somewhere between 60 and 70,000 units, and I've only been teaching a little over 4 years. I'm super proud of that. What I'm known for, by the way, and Jose and I talked about this before we started recording, is I'm known for mindset and psychology, how really 80 to 90% of a person's success in anything is just that, the mindset and psychology. They actually have to take action with what they learn. And that's why my students have been so successful. If you come to my bootcamp, by the way, the first thing we do for the first hour and a half is goal setting on steroids, because how the hell do you get anything if you don't know what it is, right? You got to know what you want with clarity. So, just know that you come there and you will laugh, you will cry. It's not like your typical real estate boot camp. I'm just going to tell you that. We do a lot of exercises. We have a lot of fun stuff. You'll create your identity statement. You'll do all these things that will help push you and propel you to actually take action with what you learn there.
What would you say would be the things that somebody has to get competent on before getting into the apartment complex game?
Okay, let's talk about the different things we train at the boot camp. Building your team. That's number one. Creating your investment criteria. You can't be all things to all people. What size properties you're going to go after? What asset class? In what market? In what submarket? How do you evaluate that submarket? What do you look for? What needs to be happening there? What websites do you use? How do you get deals coming across your desk in a big way? How do you find deals? All the different ways to do that, and there's tons of them. What happens when you get a deal? How do you do a preliminary evaluation to see if it makes sense, if it's worth digging into deeper? Then how do you dig deeper? How do you do the underwriting? Then the due diligence. And I've got a great resource for that too. It's called my Multifamily Property Toolbook. If you go to Real Estate with Rod, it's on my website here, but it's like a due diligence checklist on steroids. Got every question you should ask, how to do rent comps, all that stuff. It's free, and I'm really proud of it. It's a great resource. So my website's rodkhleif.com, but nobody can spell my name. So if you go to Real Estate with Rod, it takes you there. But anyway, so how to do due diligence, how to finance the deal, right? How are you going to finance it? I mean, are you going to go with Fannie Mae, Freddie Mac debt? You're going to go to a bank, credit union? How are you going to finance it? So we have at my boot camp, I have a finance guy, a loan broker, teach that. Everything else I teach besides the syndication of the loans. How to raise all the money you need. Of course, we dig deep on the syndication and the joint venture and all that stuff. How to manage the property, how to asset management, how to hire a third-party property management company, then how to asset manage that company, because you can't just let them run loose. You got to keep an eye on them too. It's called asset management. So all of that. And then, of course, I have 3 panels a day, with I probably have about 3 or 4, that's exaggeration, probably 2 to 3 billion represented by the panelists on stage to answer all the questions. We'll do 3 panels a day. A lot of them are my students. And of course, we spend time on mindset. So you take action with what you learn. It's a lot of fun. But regardless, those are the things you need to learn. Whether you learn it from me, you go to YouTube University or whatever, but those are the things that you'll need to learn to go do this business. And a lot of pieces. Now, the beautiful thing about this business is it's a team sport. You're not going to do them all. Okay. In fact, don't even think you're going to do them all. Nobody does any scale in the multifamily business by themselves. Yes, you can do it in single family and wholesaling and all that stuff, flipping, but you're not going to do it in multifamily, commercial multifamily. You're going to connect with a team, and maybe you're the mouthpiece like me. Maybe you're the one that's out there talking and building relationships with brokers and investors, or maybe you're the analytical introvert that's doing the analysis, or maybe you're the process person that's great with project management or managing people and you do the asset management. There's a lot of places you can hang your hat and help a team. And that's really another great reason to come to an event like mine, because there'll be 1,000, we're expecting 1,000 people, and there'll be a lot of like-minded people that you can connect with. A lot of relationships are built at events like mine where you connect and you see who needs help and you need help and you get together, and it's awesome.
I love that you say that because a lot of people, when they look at something like this, they think that they have to do it all themselves. And they think that they're either going to be the one raising the money or they're going to be the one underwriting the deal, or they're going to be the one doing the property management on the building. And I think it's really important. So let's say that I wanted to be the money person. How would I go about doing that? Assuming I can reach out to people that aren't in my immediate circle, meaning like, what's the best way? Do I find the deal first and then raise the money?
No. Oh God, no. No, 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 no. No, no. That's a big newbie mistake. You are absolutely building relationships before you find the deal. In fact, I'm just putting the finishing touches on a course on branding, on how to create reach. I'm literally just finishing it right now. The PowerPoint got sent to me right before this interview, and I told him I want some more graphics on it. But the point is, there are so many opportunities for you to create reach right now. I mean, my podcast, for God's sakes, 13 million downloads. It's almost unfathomable. My Facebook group, I've got 45,000 people in it just because I managed it. Christ, they've got me on freaking TikTok now. I've got a video on TikTok that's got 800,000 views. That was been 3 months ago. So the point is, there's so many ways that you can create value. Now, here's what I'll tell you. Here's 2 tips. Pick a channel that you enjoy. Like you like YouTube, Jose, right? You're good at it. You look good. You got an awesome backdrop there, and you're adding value, right? And even if you don't know the business, if you just by being the host and bringing in experts, you're perceived to be an expert. So you can do the same thing. You can act as if, you just act as if, and you can create a meetup group. You can do a YouTube channel like Jose here. You can go on Facebook, start a Facebook group. You can do a podcast. There's just so many ways. Like I said, TikTok, LinkedIn, Instagram. So just pick one that you like, or pick a couple that you like. And here's 2 things you got to remember. One, you have to be consistent. Okay. If you're going to do it, just assume you're going to do it for years. Okay. That's number one. And be consistent, put out weekly, whatever. Second thing is you've got to add value. If you put out crap, you are crap. Okay. So, you got to put out, stuff that has value, and you can do it through interviews, reposting things, so on and so forth. So once you start creating that reach and adding value, then it's very easy to say, hey, I've got a deal. If you're interested, ping me and I'll send it to you. Okay. I tell my students, listen, if somebody holds still long enough, they better freaking know what you do, right? You have what's called an elevator pitch. And so, so we buy multifamily properties in emerging markets, and finding some great deals. And we're always looking for partners. So if you know anybody, please let me know. It's that simple. Okay, there you go. There's an elevator pitch. But anybody, like I said, that holds still long enough needs to know what it is you do. And that's how you build that reach. And you do it through connection. In fact, I just interviewed somebody from my show that wrote this book called The Laws of Likability. And it was awesome. It was all about networking and how to network. And I took away some great things. So that'll come out in the next couple of weeks if you want to hear that. If you're introverted and you're not, that seems uncomfortable to you. But again, you can wear many different hats in this business. You can be the bird dog finding the deals. You can be the one that underwrites them. You can be the one that builds the relationships, like you just asked, raises the money. You can be the one that does the project management. There's just a lot of hats to wear.
Is it still possible to raise money belly to belly? Like, let's say that I don't have social media. Is there a way to raise money, or how does somebody go about building relationships with people with money? Is there like a list of people that are already accredited investors?
You can buy lists, but I got to tell you, the best way is to go to places where these people are, go to meetup groups, go to your Rotary Club, go to networking events, go to, philanthropic events, and just build relationships. You start by building rapport. You find commonality. Hey, how about those Broncos? Or women are great at this. Oh, I love how you look in that top. Or, men are just great. So the point is you build rapport, and you find through commonality, and then you just start a relationship. And the best networkers have a deep curiosity about the other person. Okay, remember that. You want to network, have a deep curiosity. And frankly, introverted people are better at this than people like me who are extroverted, because they're not as impatient. They'll sit there and focus and really take their time with someone. And so, you have 5 seconds of courage. And my 5 seconds of courage, and I have this too, that fear of being embarrassed or humiliated. And I got past this by just holding my hand out and saying, hey, I'm Rod Khleif. I don't think we've met. And then just ask questions. I used to have an index card with questions. So so I'm not fumbling. So, why are you here? What do you love about this? What are you enjoying? Whatever, just a whole list of questions that I have. So if you just have those 5 seconds of courage and ask questions and just have that deep curiosity in someone else, they're going to talk and they're going to think it's the best conversation they ever had, because they're the ones doing the talking. It's like Dale Carnegie's book, How to Win Friends and Influence People. It's all about having that genuine interest in someone else.
So basically hang out where they hang out, or the other way is obviously even like a podcast or just different ways of getting out there and bringing guests like yourself, obviously, that know what they're doing.
And you don't have to have thousands and thousands of people following you. You can have a few hundred and kill it. I mean, if you listen to my podcast, you'll see people that had 5,000 doors before there was social media, and they did it by having their own little meetup group. It wasn't even a meetup group back then. It was just a real estate investor club meeting. And they'd have 30, 40 people show up, and they raised millions of dollars from a small group of people because they networked. And so, don't think you have to have 13 million downloads like me. You just have to start adding some value, and the people that are the most successful people on the planet are the ones that add the most value. So don't focus on an instant return, just focus on adding value, and the return will come.
Like for meetup places, like I understand like a Rotary Club, I understand obviously different business organizations. Are there certain ones that have people that are more favorable towards real estate?
Well, sure. There's real estate meetups. There's tons of them. I mean, every town has real estate meetups. Some of them have a lot of old people that really just go to talk and have friends, but they're also, and you can create your own as well. You can set meetup.com. It's easy to start one, and you may only have 2 people show up to the first one, but if you add value and it'll grow, and that's one way. And you bring people in to talk. You bring me in, whatever. People like me, and there's lots of people that would love, particularly operators, ones that have deals and want to raise money. They'll come and talk shop with you all day long. And again, by bringing them in and interviewing them, you're perceived as an expert. It's a beautiful thing. And then you become an expert by virtue of being involved and immersed in this exciting business that we're in.
As it relates to seller financing, you said something about, which I love the fact that you're like, I look for properties over 20 years old.
Owned for 20 years. Owned for at least 20 years. Right.
Owned for at least 20 years. How do you know like how much money they would make traditionally? Like how do you run that analysis? Is there like a calculator that gets done?
Well, you mean as it relates to their tax liability?
Yeah, as it relates to the tax liability.
Listen, if they don't have any write-offs, they're going to pay capital gains and they're going to pay taxes on it. And it's typically at least 30%. So, even if it's only 20%, whatever, they can go to their tax person to find out what it is, but they're not going to be able to keep it all. Okay. That's the bottom line. Now, if they sell it to you and they finance it, then that tax burden will get spread out over freaking 30 years or 20 years, however long you amortize it. And they're getting that cash flow, and they're getting an interest rate that's respectable, 3, 4, 5, 6%, that whatever makes sense. And you can pay a decent interest rate and still the numbers will still pencil out where you're having, great returns on the property. And they're thrilled because they're getting that consistent cash flow secured by an asset that's got a lot of value that they're familiar with and happy with and comfortable with. So, it's a win-win all the way around. So again, if you don't have that conversation, with a retiree, you're screwing up. You're screwing up for yourself, but you're also screwing up for them, because very often it's the best solution for them.
To basically do the owner financing.
Absolutely. For them to finance it rather than put the money in the bank and get the cash flow from the bank. They get a lot more by leaving it in the asset. I've helped, people buy 500 doors. One guy buy 500 doors that way, larger apartment complexes, by having those conversations and putting those deals together.
How do you pitch that to the owner?
Yeah, I'll do it again. Mr. and Mrs. Smith. So I'm going to buy your property for $1 million. Now, because you're fully depreciated, you've owned it over 20 years, not going to have any write-offs. So after Uncle Sam takes your chunk, let's say you end up with $700,000. If you put that money in the bank at 1% interest, here's what the payment will be. Now, if you work with me, I'll give you enough of a down payment so you know I'm serious, but I'll pay you 3, 4, 5, 6% interest. And so here's what your payment will be from me, and it's 3 times or 4 times what you're going to get from the bank. And it is. And so that's how you do it. And again, and of course it's secured by the property. It'll be insured. You know the property, and it's not a scary thing that's securing the asset. They're familiar with it. And, and if you decide to put some money down, then obviously they know if they have to foreclose on you, you'll lose your money down. So, but again, if you bond with that seller and you may not have to put any very much down or maybe a smaller amount. I'm not going to say you're going to always get them to do it no money down. Please know that, okay? Chances are they're going to want some money down, but then you could also go raise that money down. Go find somebody that's got a few bucks to put up the down payment and they get a piece of the deal. There's so much money looking for deals right now.
Talk to me about creative financing. So like, let's say I'm buying $1 million property and they are asking for a $200,000 down payment.
They'll carry, let's say the first, you get somebody to put up the rest to take a piece of the deal or put a second on the property. So that's a way to be creative. You can also do what's called a master lease where you lease the property. I'm not that familiar with those. I've never done one, but there are people that swear by them where you actually just lease the property with an option to purchase. You can do what's called a contract for deed, where instead of owner finance, it is a version of owner finance, but it's just the security mechanism. I will tell you, some of the most successful people in the real estate business are the ones that are great at solving problems. Okay, they put their problem solver hat on and they look for solutions for that property. Sometimes it's a different use. Sometimes it's taking a piece of it and carving it off, or it's just a lot of deals have what we call hair on them, and if you can figure out how to solve that problem with that hair, you're going to be a success. So, there's every scenario under the sun. And I'm going to tell you, I haven't done that. I haven't done creative deals in a very long time because my stuff is pretty much syndicate. I bought, 3,000-4,000 units in the last few years under syndications. And it's been candidly 15, 16 years since I bought a house. I've owned 2,000 houses that I've rented long-term, just so you know. That's a business I know quite well, but I'll never buy another house for anything other than for me to live in. In 2008 and 9, I lost $50 million and it was because of my houses. It wasn't my multifamily. I had 800 houses and I had several apartment complexes, and it was the houses that pulled me down, even though I was a very low loan to value. I started my podcast was to tell people, if you're going to buy and hold real estate, for God's sakes, do multifamily. Don't do single family. Ask me how I know. And I have the hashtag Ask Me How I Know t-shirt we sell at my boot camps because I made every mistake under the sun. And one of my students, because I'll say, you don't want to do that. Ask me how I know. And so I said it so many times, one of my students got me that shirt. Now we sell them.
Can I ask, like you said that the houses got you in trouble. What was it about the houses versus the multifamily that got you in trouble?
Here's what it was. I had 800 houses, 2 hours north of me, 2 hours south of me, and everywhere in between along the Gulf Coast of Florida. All right. So Florida, no state income tax, higher property taxes. What does that impact? Cash flow. I had properties in wind and flood zones, higher insurance. What does that impact? Cash flow. What really killed me though was if I sent a maintenance guy to one of my apartment complexes, everything's the same. Plumbing parts are the same. The appliance parts, the locks, the windows, the HVAC, it's all the same. So we could stockpile parts and they're in and out in an hour, right? Well, if I had to send someone to one of my houses and it's an hour and a half away, one way, they'd have to go there, see what's wrong, then go find a Home Depot or a Lowe's where we have an account. That could be an hour round trip. And I don't know about you, Jose, but when Rod's happy ass tries to fix something at his house, he ends up going to Home Depot more than once because he forgot something. So, and maintenance guys, the same thing. So what took an hour at one of my apartment complexes took all day at one of my 800 houses. Now, these were C-class houses. There's A, B, C, and D. D is the hood. These were C-class. But C-class is older. It's a tougher demographic. They're harder on the properties. And so there's a lot of maintenance. So that really ate my lunch. But then the coup de grace, the guillotine, as it were, to cut my head off was I didn't pay attention to demographics back then. If somebody had a good credit and they had, money to rent, I rented to them. I didn't pay attention to where they worked. Well, what I discovered was a lot of my renters were contractors, plumbers, electricians, drywallers, painters, roofers, and that fell off a freaking cliff in 2008 and 9. They didn't have work. So, and here's what's crazy. I was at a 30% loan to value. I only owed 30 cents on the dollar in 2007. Okay. And by the end of 2009, my portfolio was upside down. It had dropped more than 70%. That's how much it dropped here. So people are like, oh, you were over leveraged. No, I was not over leveraged. But if you're going to buy and hold, for God's sakes, do multifamily. Don't do single family. It's much easier. It's more scalable. Believe it or not, you will cash flow better. It's harder to cash flow with single family. It just is.
Was it also that the single family didn't have sufficient cash flow, or everybody just stopped paying basically at that time?
No, everybody stopped paying, man. And it was, yeah, it was, and it was ugly. I was the one that bought foreclosures, and I was in foreclosure in hundreds of foreclosures. It sucked. I'm going to tell you, it just sucked.
Now, what if I do the syndication model, and or what if I did? What if I said, okay, look, I'm gonna do the syndication model. I'm gonna raise money. What would be a typical rate to offer? What is a typical structure to offer in a sense of a syndication if I'm raising money?
It's going to get a little complicated now, okay? Just so you know, it's going to get a little deep. So typically a syndication will have what's called a preferred return to the investors that put up the money, anywhere from 5, 6, 7, 8%, okay? So that comes off the top from the cash flow. That return gets paid before there's any splits. Then there's a split between the general partners like me that put the deal together and people on my team, and the limited partners that put up the equity, the money, all the money for the deal. That split can be anywhere from 90-10 to 50-50. My last deal was 50-50 because it was a screaming deal. I'm looking at a deal right now in Sarasota, Florida, and it'll be a 70-30 deal. I had to do 70-30. It's an A-class property. It's the only way I can make the numbers work for my investors, so they get a nice preferred return and a split. So again, typically what you'll do is you'll have that preferred return, and then you'll have a split. And so that's how it works. And then when I say general partners, they're the operators that are putting the deal together. And see, the beautiful thing about this is, you've got to have a net worth equal to the loan amount to qualify for most of this debt. And you have to have liquidity equal to 10% of the loan amount after closing. But it's the team. It's not you. You find one high net worth individual that can satisfy those requirements, and you can bring that person in and give them a piece of the deal just for bringing their resume, for bringing that net worth and liquidity. Okay. So, a deal can get carved up and sliced up pretty good. You've got at-risk capital. You've got somebody that brings the deal, gets a piece, somebody that brings their resume, their experience to the table. They're the sponsor. That's me in many cases. You'll get somebody that does the asset management, which is a big piece because that goes on for years after the purchase. That's typically a big chunk of the deal. The money that's brought into the deal, the equity that's raised, those people get a piece. Now, you cannot just raise equity, just so you know. You cannot do that unless you've got a Series 7 or a Series SEC license. You have to be actively involved in the deal. You cannot just be a money raiser.
And then when you say 50 or 70-30, is that 70 to the investor?
To the investors, yes. It's to the equity, 30 to you. Mm-hmm.
So basically, the better the deal, the higher the split that you would get.
Yeah, most of my deals have been 50-50, but the market has been so hot.
Perfect. And then does a preferred return mean that it gets paid monthly, or how do we determine that?
It can be paid monthly. It can be paid quarterly. We pay it monthly. Yeah, it can be both. Depends on the operator.
And then last question that I had for you, Rod, can you give me an example? Like you said, like this person gets a piece of that person gets a piece of that person gets a piece of that. Can you just give me one example as to how to slice up a deal?
That's a very complex question. I'm just going to tell you right now. In fact, it requires a spreadsheet, okay? And you'll have a spreadsheet, and you'll have, say, 10% for whoever brought the deal and did the underwriting on the deal. You'll have maybe 10% for whoever brings their resume, net worth, liquidity, experience deal. You might have 30% for the asset management. You might have 10% for the at-risk capital. Whoever the equity raise could be another 20, 30%. So you get to 100%, carve it up that way. But in each one of those slices, you could have 3 to 5 people. So it gets kind of complicated, if that makes sense. You could have, you've got the initial slice for each section, but each section could have several people in it to make it work. So again, without having a visual, it's hard for me to show you what I'm talking about, but hopefully you got the idea at least.
I believe this is all stuff that you cover in your boot camp, right?
Oh yeah, no, we go in great detail into all of this stuff at the boot camp. And again, if you're just coming on, $197, seriously, text my name, Rod, to 72345 or go to multifamilybootcamp.com. And just remember to use the code bonus when you check out. You'll get my deal evaluator software. You'll get my document library. And it's not a sales pitch. Now, it is drinking through a freaking fire hose. So you got to bring your A game because, it is. It takes me almost 2 weeks to recover because I'm up for 3 days killing myself. But it's a lot of fun. I had a ton of value. We have a great time. And we go into all of this in great detail. So
I want to say thank you, obviously, for being on the show. Obviously, you know what you're doing. And I just want to encourage our viewers that if you have any additional interest in learning more about how to buy apartment complexes with no money down, Rod is the perfect person to help you. And then Rod, what's the best way for them to get a hold of you?
Yeah, if you got questions about this business, DM me on any social channel. I'm very responsive. Or go to realestatewithrod.com. Again, that's my website. It goes to rodkhleif.com, and there's tons of free stuff there. There's videos, there's books, there's articles, tons of free stuff. Listen to my podcast, for God's sakes. Lifetime cash flow through real estate investing. I do it, by the way, besides interviewing the best people on the planet in this business, I also do a clip every week called Own Your Power. And that's what it's about. It's about owning your power. It's motivational. I just did one on playing to your strengths this week, but every week there's hundreds of them there. You give me 5 minutes a week, I will juice you. I will motivate you and help you really kick butt that week. And those are called Own Your Power. And there's music, and they're really dynamic. I'm really proud of them. So my podcast is big, but like I said, I'm active on pretty much every social channel. I've got a pretty decent social media team. But thanks for having me, Jose. I really appreciate it, brother.
Yeah, likewise. And to all of our viewers, this was episode number 121. We had Rod Khleif. He taught us basically how to buy apartment complexes with no money down. If you've enjoyed this episode, make sure to hit that subscribe button. And if you feel that this episode will be helpful to somebody that you know, feel free to hit that share button. Thank you so much, Rod. Thank you again. I appreciate you. And thank you so much for taking the time to be on the show.
Thank you.